Welcome to this online presentation of Small Business Accounting presented by the Small Business Development Center at Columbia Gorge Community College. The video you are about to watch is one portion of this online course and is meant to accompany the resources and activities we complete during the class. For information about enrolling in the entire program, please visit the college website, which will be provided later. During this presentation, we will define and demonstrate the double entry system of accounting. You will also see the importance of keeping accurate record of all financial transactions in a business. We will show how these transactions create different ledger accounts that can be tracked by the business and how all of this information creates the financial statements that are used by a company. Let's look at some reasons why a business should bother to keep financial records. First, it allows you to monitor the financial position of your business. This is important to let the business know if it has the financial capacity to conduct normal business activities, such as making purchases, paying expenses, or taking on a new project. Without financial records, the business would not be able to create accurate and timely financial statements. A proper record of financial transactions is also part of the information an accountant needs to prepare annual tax returns. Let's take a look at some basic accounting definitions that will be used during this course. The double entry accounting system tracks each financial transaction with two accounting entries using debits and credits. Assets are things of value that your company owns. This could be items such as cash, a building, or your accounts receivable. The opposite of this is liabilities, which are obligations of the company. Examples of liabilities can include accounts payable, long-term debt, or a short-term loan. The difference between assets and liabilities is equity. The basic accounting equation represents how these terms we just went over are related. These terms and concepts are discussed in greater detail during other courses that we offer. As mentioned in the previous slide, every transaction in the double entry accounting system has two components, a debit and a credit. Credits must equal debits. Incorrect entry of debits and credits will create errors in financial statements. For example, the balance sheet will not balance and the basic accounting equation we looked at earlier will not calculate correctly. Modern accounting software will often ensure that both entries are created. The software may require you make both entries, or the program may make one of the entries for you in the background. Even though the software is very helpful, it still requires someone to enter accurate information into the system. Some of you may have heard the computer term garbage in equals garbage out. Well, if inaccurate or partially complete financial information is entered into the system, none of the information provided by the program will be accurate. Now let's look at what is often the most confusing part of accounting, debits and credits. Debits and credits are used to track financial transactions. When discussing debits and credits in accounting terms, it often seems backwards from how these terms are used in everyday life. I believe this is mostly due to how debits and credits are discussed during banking transactions. However, we must remember that when doing banking, everything is stated from the perspective of the bank, not necessarily the customer. We will see later that a credit transaction increases a liability account. This seems backwards, doesn't it? Because we view a credit to our checking account as an increase in our balance, which is an asset to us. However, your checking account deposit is a liability for the bank. They have to pay you back. This is why they state that they have placed a credit to your account. Keep this in mind as we look at how debits and credits affect different account types. Now we will look at the basic definitions of debits and credits, and really this is all that most of us will need to know. Starting with debits, we said that a debit entry increases an asset and decreases liabilities and equity. Credit entries increase liabilities and equity, remember the bank example, and decrease an asset. Here's a chart that summarizes all you need to know about debits and credits. I recommend that you print this chart out or print out the charts in the resource section of the class and keep it handy as you work through the exercises during this course. Let's look at some examples. In this case, we need to record a sale to a customer who will be billed for payment. this transaction will hit your accounts receivable ledger. Since accounts receivable is an asset item, we'll need to debit it to increase its balance by the $1,000 sale we made, which will be collected later. The credit entry in this case is a $1,000 credit entry to sales income. Now, let's look at what happens when they pay you back for the purchase and you collect the receivable owed to you. You will need to record the collection of payment, and this will be accomplished by a debit entry to your cash ledger. Remember that a debit increases an asset account and cash is an asset. You will then need to reduce your accounts receivable ledger by making a credit entry for the $1,000 received. This transaction is now complete and balanced. Another way to illustrate the nature of the double entry accounting system is to look at the T account. This is a simple accounting structure that represents the dual entry nature of accounting. Each ledger account can be represented by a T account. This T account tracks all debit and credit entries and reconciles them into an ending balance. This balance then flows to the financial statements of the business. Here are some examples of the T account structure. You can see how each account type can be individually tracked and balanced each time a financial transaction takes place. Let's look at some more examples using the T account to illustrate the debits and credits concept. Here we see the cash and notes payable accounts. This slide shows the entry of a $50,000 long-term loan taken by a business, with the proceeds being deposited into the cash ledger. Again, a debit entry increases the balance of the cash account, and a credit entry increases the balance of the liability account, which in this case is notes payable. Currently, the balance in each account is $50,000. Continuing this example, we see that the company uses $30,000 of these loan proceeds to purchase some equipment. The reduction to cash comes from a credit entry, and the debit entry increases the balance of the equipment ledger accounting for the new equipment. Remember, cash is an asset, as is equipment. A credit entry reduces an asset item, and a debit entry increases an asset item. The new cash balance is now $20,000. Here's one more example for this company. In this slide, the business needs to purchase a $20,000 truck and will do so by placing a $2,000 cash down payment and financing the remaining $18,000 balance. The vehicle ledger is debited by the full value of the vehicle, in this case $20,000. As a vehicle is an asset, this account must be debited to increase its balance. The $2,000 down payment reduces the cash ledger, and this is accomplished with a credit entry. The additional loan is accounted for with a credit entry to notes payable. Remember, a credit entry increases the liability account. You can see how each account now has an ending balance that reflects all the transactions we demonstrated. If we were to now look at the company financial statements, we would hope to see that the balances here match the balances on the financials. Here are some examples for you to work out on your own. Use your debits and credits chart and determine the correct credit and debit entries for each transaction. These same questions will be used for the online quiz in this course. By taking the quiz, you will be able to check your answers. An in-depth look at financial statements can be found in the Financial Statements Made Easy course, which is a prerequisite for the class you're currently looking at. However, let's take a moment to quickly review some key concepts related to financial statements and accounting. The financial statements contain information about all of the financial activities of a business. Each transaction will ultimately find their way onto the business financials. Financial statements will only be accurate if these transactions are tracked and inputted correctly. Financial statements may be historical, showing where the business has been, or projected based on future expectations. On the next two slides, we'll review the basic components of two important financial statements, the balance sheet and the income statement. The balance sheet is a financial snapshot of what the business owns and owes at a specific moment in time. This means the balance sheet will be pulled as of a specific date. For example, you will look at your 2010 year-end balance sheet as of close of business, December 31st, 2010. This is much like your current bank balance, which shows your balances as of the moment the balances were calculated. The balance sheet is cumulative from the day the business was started. Again, relating it to your bank balance, the balance on your bank statement is the cumulative total of all deposits and withdrawals made to the account. As the name implies, the balance sheet must balance. This is again represented by the balance sheet formula, where the value of assets must equal the current balance of all liabilities less any remaining positive or negative equity. If this does not hold true, there are accounting errors that must be corrected. The balance sheet often receives more attention from a lender than any other financial statement. This is because it can tell us a great deal about the financial health of a company. Let's look at each section of the balance sheet, starting with assets. There are two types of assets we will discuss, beginning with current assets. These are cash and other assets that will be converted to cash within 1 year. Examples of current assets include accounts receivable, which are normally collected within a year, inventory, and any prepaid expenses. Current assets are the most liquid assets of a business. Fixed assets are longer-term assets that are not expected to be converted into cash or sold within 1 year. These are assets such as land, a building, equipment, and vehicles, and are more permanent in nature. Now we will look at the liabilities and equity sections of the balance sheet. Liabilities are classified in a way similar to assets. Current liabilities are obligations owed by the business and are due to be paid back in full within 1 year. These may include items such as accounts payable owed to your vendors, a line of credit, or payroll taxes. Long-term liabilities are longer term and will be repaid in a year or more. These include loans for buildings and equipment, as these assets are normally financed over a term greater than 1 year. As we know from the balance sheet formula, the last component of the balance sheet is equity. This is the net worth of a company, or the difference between what the business has in assets and what it owes in liabilities. Here's an example of a balance sheet from an actual business. Please pause the presentation and take a moment to look it over and review its format. The income statement is sometimes also referred to as the profit and loss, or P&L. Unlike the balance sheet, which is a snapshot view of the business, the income statement measures performance over a period of time and will have a start date and an end date. This time period could be anything from daily, monthly, quarterly, semi-annually, or once a year. The end result of the income statement is a calculation of the net profit or loss of a business after all expenses are deducted from the revenue the business earns. This statement is typically the most popular financial statement amongst business owners, but not necessarily the most popular with the financial community. In reality, both the balance sheet and income statement are very important to the success of a business, as we demonstrate in the financial statements course. Let's take a quick look at the basic components of the income statement. Sales are the revenues generated from conducting business activities. The cost of goods sold is the cost incurred to have items available for sale. This may include material costs or the direct labor necessary to produce a product to have it available for sale. The total revenue, or sales earned from selling your product or service, less the cost of goods sold, represents your gross profit. Let's look at an example of how this could work in a business. Let's say that you own a business selling television sets, and you sell a television for $500. This $500 would represent your sales figure on the income statement. You probably had to buy this television from a supplier so you could have it available for sale. If your cost to buy this television from the supplier is $300, this would represent your cost of goods sold. Sales minus cost of goods sold in this example would give us a gross profit of $200. To complete the income statement, we could then deduct all expenses, which are the costs incurred when conducting business activities. These could include several items such as payroll expense, depreciation, utility expense, rent, or business-related travel. Subtracting expenses from our gross profit results in the net income or net loss of a business, which is what is left in the end. Here's an example of an income statement from an actual business. Again, feel free to pause the course and take a moment to review this statement. This concludes this presentation. Again, a more in-depth look at financial statements can be found in the Financial Statements course. Please visit the website shown here to learn about this and other programs that we offer. As mentioned earlier, this presentation is one portion of the overall course. Please continue with the remainder of the online class, and as always, if you have additional questions or comments, please post them in the questions forum.